we ready to go? Let me share my screen. Right. So we're very close to some of the I like to call the peak week. All right. Before we start, I just want to show something here on my YouTube channel. ACY. This one. This video here. All right. This video is pretty cool. And what I say is, forget about crypto, go to the moon. So this is my thinking right now. Okay, so forget about crypto and let's have a look at gold and gold to the moon. Okay, this is my perspective at the moment because lots of people are looking to gold, right? They are looking to gold. Lots of people. Yeah, it did, right? There we go, all-time highs here. So I continue to think that my target is at 2,180, and I've mentioned it here. Hey, Kumalo, sorry, man. Didn't answer you. I'm just opening it now. Here, where is it? Gold. Here, this one. So, okay, so if you click on the link here that I sent to you guys, it's going to, of course, go to FinLogic's page. And while you are there, you have this play button. So we have lots of analysts in there, okay? And I've mentioned long gold on here, okay? This was the time on this green line. So there we have it, all right? And here is the analysis. So I'm looking at the 2,180, all right? 2,180. This will be my target. 2,180. Okay, this will be pretty much my target for gold right now. It's a simple fib projection, as you guys can see here. You know, nothing crazy. It's just the 161 of fib right here, and pretty much the price that the fib is saying is 2,178. But I'm just making it rounded to 2,180. Okay, so that's pretty much it for me on gold, right? No surprises until then, as we are breaking the all-time high on gold, right? And it did break through pretty well. But if I want to enter the new position, should I enter or wait for the pullback? Look, I can't tell you that, unfortunately, you know, because that would be a personal advice on trading. But I recommend you to always pay attention on pullbacks, okay, and always follow the trend. This is not what only me recommend. It's most of the traders around the world recommend. You know, like pushback and then a pullback, and push up and then a pullback, a push up and then a small pullback, a push up and then a pullback, and a push up, and maybe we have a pullback here and then a push up. But the thing is that we are on the all-time high. So maybe we don't have pullbacks, or maybe we go all the way down. Okay, maybe we do this. Okay, because there is the possibility, right? So I would say it's up to your strategy. So if your strategy waits for pullback, then that's great. But if you think the momentum can continue, yes, you can enter here, let's say. Okay, but it all depends on your strategy. But we're pretty close to the target, right? And then it comes to another question: how is the risk reward here? Okay, because if we look on the risk reward, let's say you want to enter here, my target will be here. Okay, and this is a 1-to-1 trade. Remember what I've always said to you guys: 1-to-1 trades are not profitable on the long run. Okay. Why they're not profitable on the long run? Well, there's lots and lots of reasons why 1-to-1 is not profitable on the long run. Primarily is that 1-to-1 means that if you're losing one, you will gain one. Okay. Let me, where is this thing here? Nope. No. There we go. Right. So this is the big thing about 1-to-1 trade. So if you lose one, you get paid one. Well, the thing here is that 1-to-1, there's much more than only the profit, right? It doesn't go only for the profit. It has much more inside of that. You can't forget that you have your commissions, right? Commissions. You can't forget that you have your spreads, right? And you can't forget that you have market variance. Oopsie. Market variance. So you have commissions, you have spread, you have market variance. So in the long run, this 1-to-1 will not be 1-to-1. It may be like 50, like 0.5, sorry. So half. So you're losing 1% and gaining 0.5%. So then you're going to have to start to do 2 trades to cover one loss. All right. 2 trades to cover one loss. So what does that mean? Oops, sorry. 2 loss. What does that mean? Means that this is not good. The good one, including commissions, spread, and market variance, would be around 1 to 1.8. This would be a good one. Why? Because let's say you lose 2 trades. Well, you down. Let's say you lose a trade, right? Let's say you lose a trade. One losing trade. This will be equals to minus, minus 1%. Okay. Now, let's say you then go and win one trade. Okay. You go and win a trade. This will mean that you just had 1.8 of winning. Okay, so the 1% that you lost will come to here, and the 0.8% will be a solid gain. Okay, so this is the magic. Well, you don't have any magic here, but you know, just like telling you guys that's how it works. In average, this works pretty well on gold. All right, this works pretty well on gold. But if you have another how do you say risk management techniques, then it's up to you as well. But I would recommend this one to 1 to 1.8. Okay, because then in the long run you can cover your costs. The worst option would be you getting to break evens if you get too much losses and winnings and losses and winnings. But remember, guys, when we talk about risk management, we have one simple thing that goes across these. Okay, that is the winning percentage. Okay, winning percentage. So the winning percentage does matter. people think that winning percentage doesn't matter, but winning percentage does matter when you're using. Well, winning percentage will matter when you are actually professional on what you're doing, because if we go for professionalism here, you know, I can talk very, very professional stuff with you guys, but I don't think it's appropriate, let's say, because okay, when you want to know your winning percentage, I would need to know your beta, compare it to your benchmark. Okay. Okay. I would need to know your alpha on AUM. I would need to know your DD, and I would need to know a few other stuff. Vigor as well. Okay. Vigor implemented on beta. That's a good math to go. So there's lots of things that we can go. Oh yeah, and of course the KC as well. Let me go down. Okay. This would be the most important ones. Now, what is beta? What is beta? What is alpha? What is all of those things? Well, first of all, to calculate beta, right? Beta. It's a very simple equation, but very, very, I would say, accurate, right? But we need to know the benchmark. What is a benchmark? It's a, let's say you have, we know when people talk to you about you need to treat up your trading as a business. So this is exactly what I'm trying to teach you here. You need to you need to use your money that you're trading exactly as a business. You need to know how much get in, how much get out, what's your profit, what's your cost, you know, because you do have spreads, you do have variance, volatility, you have, you know, Vega, that is pretty much the volatility. We call vol as well. Okay, what's your vol? And bits and pieces. So the beta will be pretty much the variance that your portfolio suffers, compare it to the benchmark that you chosen. So let's say the benchmark is the S&P 500. So if you have a beta of 1, that means that your portfolio have the same volatility as your benchmark. So your benchmark can be S&P 500, as I just mentioned. It can be gold. It can be, you know, rates, fixed income, sorry. It can be anything. So if you have higher than 1, that means that your portfolio, so 1 higher than benchmark, that means that your portfolio is much volatile and much more open to volatility than your benchmark. So let's say your benchmark closes the month as, I don't know, like 1%. Okay, 1% up, positive 1%. Okay. That means that this number here, 1, compared to your portfolio, will be exactly the same. So your portfolio will close 1% up or 1% down. All right. So now you have a 2 beta. All right. You have a 2 beta. That means that if the benchmark closes at 1% up, it doesn't matter if it's up or down. Okay. It doesn't matter. What it matters is how much it closed it in percentage. What was the variance between the open of the month and the close of the month in percentage? 1%, 2%. Okay, cool. 1%. Now your beta is 2. So that means that your portfolio closed the month with a 3. Right? So if your beta is higher than 1, you're already very volatile. If your beta is lower than 1, then you know you're much less volatile. And why would an investor put money on you? Because he can get better returns and more volatility on a benchmark. that you're trading. Volatility is not always bad. Okay, volatility is not always bad. Volatility is good if you know how to use it. Okay, too much volatility can kill you. It's like water. Too much water can kill you. Okay, but too less volatility can't do anything. Too less water, it can kill you as well, but like, you know, you can't do much. You're not going to be able to walk because you're going to be dehydrated and so on. Okay, so alpha, it stands for percentage of gain. Okay, percentage of gain. And AUM stands for asset under management. Asset under management means how much money you have trading. DD means, double D means drawdown. I think most of you know that. Vega means volatility, as I just say, and KC means Kelly score. This is something that I would love to teach you guys because that's very important, right? Let's say you have $1,000. Okay, that $1,000 you need to trade as a business, as I just mentioned. Okay, you need to know how much money you're gonna put into trade. Well, you can put $1,000, like, okay, that's not a problem, right? Whatever. Okay, that's not a problem. You can put $1,000 at risk. You can go and put $1,000 in the same asset, right? I'm not talking about notional value here. That is how many lots you open. I'm talking about how much you're trading. So let's say you're trading with $1,000. Okay, $1,000. With $1,000, you're putting basically 100% in one strategy. Okay. Oopsie. One strategy. Let's say strategy, one strategy. So you're putting 100% of your portfolio, you're basically your AUM in 100% in one strategy. Isn't it risky? Tell me. I'm going to let you guys answer this question. Isn't it putting 100% of your portfolio in one thing risky? Because I do think it's risky. Okay. What KC does, KC stands for Kelly score. Okay, Kelly criteria, actually. Okay, Kelly criteria shows us how much of the $1,000 you should put on your beta, on your strategy compared to your benchmark, and the rest you should do other stuff. You should calculate other cases. So these minimize risks and maximize profits. So that's pretty much what everyone is looking for. Minimize risk, maximize returns. Okay, so I hope it helped. Just a little bit of risk mitigation here, you know, and those types of things. Answering your question now, again, Bharat, entering in gold at this moment can be risky just because we don't have a good risk reward ratio. Okay, this is my opinion. Okay, now let's go ahead. Okay, let me put this on my time frame, my time zone. There you go. Right, interest rates decision, exactly as we expected on, when was that? Tuesday. Okay, so let's have a look on USD CAD. If you look at USD CAD, it did drop kind of a lot. And why is that? Well, because when what is his name? I forgot his name. Forgot his name. Sorry. Anyways, when the Bank of Canada published the rate statement, let's go through these. You're welcome, Bharat. Not a problem. I'm here to teach you guys whatever you guys need. Well, it's not here. What's happening? What? They haven't rate statement where it is. Well, well, well. What? That's interesting. Anyways, we can't find it. It's not in there. So they must be took it off. But yeah, it feels like it was pretty hawkish. I didn't have time to read it. But it feels like it was a pretty hawkish move on the USD CAD. That's pretty interesting. Okay. Anyways, moving ahead. Looking now at those job opening. Job openings were pretty good for US, and indeed it was really, how can I say that? It was pretty good. You know, we had 263,000 more than expected, but it's still with 8,863,000. So I guess it is a good, you know, a good number there. Now going to crude oil inventory again, I feel like that the crude oil is just it's better than the expected here, because 2,400 million went down to 1 million. No, sorry, 2,400,000 went down to 1,367,000. Okay, when we look to the WTY, it's not coming down, and I thought it would be coming down, and it's making me a little bit afraid in a sense of, okay, we are having lower and lower supply every time, and if we continue to have lower and lower supply, then what will happen? Well, economics tell us that if we have higher demand and lower supply, the prices go up. Okay, I've explained this already for you guys multiple times, so I'm not gonna explain it again. I've explained in some of the webinars as well. And then we had the BOC press conference. I didn't have time to watch it. And then we had the exports here, China, and we had the imports that were much higher than expected. All right, expected at 1.5 and it came at 3.5. So if we looked at the Aussie dollar, look at what happened. Okay, how many hours ago? That was 2 o'clock. So what time is it? 8:30. So that's 6 hours and 30 minutes ago. 1, 2, 3, 4, 5, 6. Okay. It did proclaim, sorry, yeah, somewhere here. It did proclaim a little up move on the Aussie. Okay. I didn't had time to actually come here and looked at it to see it. What was the job? What was the imports? Okay. And the exports as well was much higher than expected. All right. So that's pretty good. And they have more than what was expected to have on the trade balance. Of course, they have much more exports, and so you know, more than 5.1%. So that was widely expected to have more trade balance. Would be good to know what are the trade balance that China had on February. I'm gonna go on this data. I'm gonna try to get this data. Anyways, now we're gonna have Spanish. That's not much. Now the big boys are these ones. ECB monetary policy statement, as of course interest rate decision, exports and imports, initial jobless claims for US. We still have, of course, the ECB press conference after 40 minutes. Sorry, after 30 minutes. So prepare, right? Be prepared, because what I have to say here, not only me, I'm going to show you is ING. Oopsie, sorry. ING ECB preview. This one. This one. Oopsie. There we go. Accept. Where is that chart? March ECB. Okay, this one. That's what I want. Okay. Let me just. How can I open? Yes, I can. Perfect. This is what I want. All right. This is from ING. All right. ING is a big bank. Most of you guys probably know. And I just want to show some of the scenario analysis that they have. Okay. Scenario analysis, how to position for Lagarde's alternatives. So euro dollar right now is trading at, let's just confirm the price, 189. So nearly, let's call it 109. Okay, it's trading at 109. Trading at 109 euro dollar post European session. Inflation outlook. This is what they think on inflation outlook. All right, this is the moderately dovish, and this is what they are expecting. All right, that's what she would say. Risks to the inflation outlook balance it. 2% target not met before second half of 2025. Growth outlook. Risks tilted to the downside, less optimistic in stance on a longer term outlook. Interest rates, of course, no hike, data dependent, and conditions for cuts discussed. Other monetary tools, portfolio runs off independent of rates decisions, and the euro dollar expected to go to 108. Okay, all right. Being pretty honest with you guys, okay, it does sound pretty appealing, this, okay, because when we look to the to the price of 108, it doesn't mean that this will hit soon as Lagarde starts speaking, okay? Because remember, guys, it's how much? Well, let's call it 1,000 points, all right? So 100 pips. So 100 pips move won't happen in a second, okay? Well, it can happen in, let's say, a few hours, but it won't happen in a second. And if we look at here, continue to look at, if she be a little bit moderately hawkish, unchanged upside risk from wages and geopolitical developments. On the growth outlook, risks remain tilted to the downside. Rising real incomes should give support, though. Interest rates, of course, no hike. No hike means for all of them, right? Just this dovish one here that, well, I don't think it will be like this. I don't think it would be too dovish. Okay, this would drag euro dollar so much down. I don't think this will happen. Anyways, and then all the monetary tools would be on portfolio runoff if dependent, very, very similar as well. Okay, so between those three choices, I'm not going to look to this one because I don't think this will be true. All right, I don't think this will come up true. Pretty unlikely. Pretty unlikely. I'm more towards looking at 108, 108.5. Okay, it's already on 109. And 109.5, that they would have to be very, very hawkish. So not keen to trade this hawkish move. Not keen to believe that this will be too hawkish. Okay, I would love to trade a hawkish move. Dollar losing its strength, euro gaining strength. I would love to buy it more. Remember, I had the, where is it? Euro dollar here. Okay, take a moment to review my analysis of the brief perspective on euro dollar and understand the rationale behind my viewpoint. If you click on here, you can see that this is my analysis and I went long, and this is how the trade progressed. Okay, Okay, so from here all the way to where it is right now. And this is the trade. I anticipate that euro dollar will likely stay within short range trading from 1072 to 109. We just hit it 109. It is interesting to note that rates below 108 don't necessarily indicate the euro weakness, but rather recent dollar strength. The euro has shown stability against a broader basket of currencies, while the dollar has been appreciating. The trajectory of the euro's recovery hinges off various factors, including how well the eurozone economy bounces back and the timing and extent of interest rates changes. Okay, I've been telling this like way longer. Recently, the Federal Reserve demonstrated the possibility of a rate cut, contrasting with the European Central Bank. Mixed signals on the timing of its first rate cut. Various ECB officials have expressed different views, with some, like Spanish ECB Governor Guindos, expressing confidence in Eurozone inflation returning to target soon. And others, like Croatian ECB Governing Council member Vucic, sorry if I pronounce it wrong, suggesting a cautious approach with no rush to cut the rates. Okay, so we are pretty on this line here. You can see that there is two extremes. Guindos is saying that, wow, we need to be confident on the Eurozone inflation returning to target soon. And as the Croatian guy saying that we don't need to rush to cut the rates. Most probably Guindos have a big mortgage. I'm just joking. The US market strength highlighted by last week's employment data release implies that unless signs of weakness emerge, the US dollar is likely to remain the more attractive currency in the pair. However, it's essential to recognize that the US dollar strength has its limits, especially unless there are escalations in geopolitical tensions. Ongoing developments in the Middle East will continue to draw attention. The release of consumer price data for January, strengthening with the German CPIs and followed by American CPIs, will be crucial. Any surprise in the data, especially if similar to the higher than expected previous CPIs, could influence the Federal Reserve's stance on interest rates. From a technical standpoint, euro dollars has been following a downward trend, breaking through the key indicators like the 200 line. The 200 moving average here, that's wrong. The January sideways trend channel and the 100-day line at 107 has resolute in a 3-month low of 107.2. While the pair hasn't directly breached this level, a further test and possible breakout seems likely in the medium term. Short-term expectations include a correction towards the 38.2 and 61.8 of Fibonacci levels at 108.116 and 108.83 respectively. Well, that was pretty much what happened here. And additionally, resistance levels on the upside at 109 and 110.40 with downside support with 72 and 67. All right, so primarily, I do think that euro dollar can come down still at the 107, 107.2, somewhere here. Okay, let me put the crosshair again. Somewhere here, okay. But it can come to 110 as well. All right, so I think what will happen today will be pretty decisive in terms of, okay, where is euro dollar going? Is it going up? Is it going down? Is it trading sideways? What's happening? All right, my opinion is down. This is my opinion. All right. It will always change if Lagarde comes in and say a completely different thing. Okay, always change it. Now, moving to what we're gonna have, NFP as well. Pay attention on the power testify here, okay? Guys, let me just grab a water because my throat is really, really dry. I'll be back in 5 seconds. Okay, sorry for the late, but yeah, as we're saying, I'm more tilted to the downside than to the upside on euro dollar. Okay, now going ahead, where is here GDP year over year and quarter over quarter for Europe as well. Of course, this will have an impact, but I don't think it will have an impact now. Okay, I don't think it will have an impact right now. Why? Well, of course, we have Euro ECB being the big boy for the day. Okay, so that's what we move euro dollar today. Then moving to Saturday. Well, it's going to be Saturday for me. It's going to be tomorrow for you guys. Today for you guys. Let me just grab it here. This is Friday and Saturday. We're going to have NFP. Right. That's the second big boy of the week. Let's have a look on the ACY US dollar index. What is happening here? Okay. Guys, I don't know if you remember that, but that was a long way behind ago. Like, that was January. But if you remember, that's good, because I've said that if we break through this support, this resistance, we wouldn't have strength to continue to go up. Okay, and what just happened is that we break through it, but we come down. Okay, and here you can have like all the let's say SMC or whatever, you know, what's the name again, Elliott wave, like 1, 2, and now being the biggest one, most probably coming to here. So all indicates to me that this NFP will be negative. Okay, all indicates to me that this negative price goes. Okay, so the thing here is, when we have a bank, right, when we have an investment bank, when we have like fund management sort of things and so on, you look to those guys, and of course they can have a little bit of risk on the AUM, but they need to have a small exposure on risk, because the big exposure needs to be on, you know, somewhat more less riskier. When we look to these, it's pretty simple to see that that the dollar is going down. Feels like the NFP will come negative, and then it makes me think again: will euro dollar actually goes down? Because euro is strong. Euro is strong. People think that euro is not strong as to dollar, but you need to take this off from your mind, because euro is strong. Dollar is strong as well, but euro have been printing much better data than the US, and they've maintained it for a while, as now the US sort of stole it. You know, it went like this, and whoa. Okay, so that was like a peak for the US dollar. I think this month most probably will be a peak for US dollar. Not only me thinking that, as I've mentioned already, I was saying this many times. Okay, who's this? Okay, now, okay, where is the thing here? So they're expecting 190,000, okay, for February. From 335,000 to 190,000. That is a big drop, my friend. That is a big drop. I want you to pay attention to one thing first before we discuss the 190,000. What just happened here? Where is it? There we go. There you go, here. Where's my pen? Okay. What's happening on the ISM non-manufacturing PMI? Not the orders. The orders are fine. I want to know the manufacturing PMI. It was expected to come at 53, came at 52.6, 0.4% lower than expected. ISM non-manufacturing prices was expected to come at 62. It came at 58.6. That's 2.4% less. Sorry, 4.4% less than expected. All right. What's non-manufacturing? I've told you guys already. I've teach you guys, but for those who can't remember, I'm gonna refresh your mind. Is actual manufacturement, is how much the country is producing in labor. Okay. So if it come lower, it does indicate to me that there may be a little bit people working in that. Okay, all right, that's good, right? So now let's have a look on here. Oopsie. Nope. Nope. Okay, here. Initial jobless claims. They're expecting to have 2,000 more than the last one. So that's not good. People are claiming to go out of the company, right? So people are getting off. And, you know, quite frankly, business can't support these higher rates anymore. It's just killing them, right? Because remember, if you have a business, you definitely will loan out money from the bank, right? It's pretty obvious that you're not well, you can be, but you can go for VCs, you know, private equities, venture capitals, and they invest on you, but they will charge you a percentage of your company. So some people, you know, do that, but some people don't, and the majority don't. So what the majority goes is go to the bank, and it's just not working anymore because we're having a loss of business. You know, all of the pandemic, all of the coronavirus, let's say like this, still have effect into the economy in a sense of they've made the hike, they've made a higher rate, and now they need to lower it in a, you know, because we are cooling off the economy. So you know how I changed my view from last year to this year? This is basically examining the economy. And this is what I want to teach you guys next Tuesday. All right. So this is my take from today. Okay. I think that we will have a higher NFP, but in a sense, I'm thinking of a dovish to neutral euro dollar. That means that euro dollar can go down. So that's just confirming my views here. Okay, that's just confirming my views here. Now, I want to show you guys what we will do next Tuesday. So let's go, whatever, let's go USD JPY. I want to do a little exercise with you guys next week that, you know, back testing, you know, like technical people do back testing. That's good, right? But I want to show you that every move that has in the market, there is a reason to happen. Okay, this move has a reason to happen. This move has a reason to happen. This move, we know why it happened, but there is a reason to happen. So I wanna show you the data behind those things here and how did actually started on the market, right? So what we will do is we will take ThinLogix, go to calendar, economic calendar. we're going to select a date that will be 1st of January all the way to March. And then we're going to select a country, let's say US dollar and Japanese yen. And we're going to go through each and single of them. Oopsie, we don't need the low ones, only the medium and the highs. We're going to go through each and single of them and going to dot plot them on the chart. It's going to be very boring, to be honest, but it's going to help you guys a lot. I'm really sure, right? So let's say here, let's just take it here. Whatever, let's say this one. Let me go back here to January. ISM manufacturing and manufacturing PMI December. So at 2 a.m. on Thursday, 4th of January. 2 a.m. on Thursday. What the day was? 4th of January. Thursday, 4th of January. Okay, so we can take this off. And what we will do is we will come here and we will make a call out. 4th of January at 2 a.m. Oh, that's a 4-hour chart, so that happened somewhere here. So then we will do this. US PMIs higher than expected. All right. And this occasionated this move. All right. And then what will happen with this move here? Well, let's find out. Okay. And we go from this dot plotting everything. Well, what just happened on here then? Let's say, okay, on this move, that's 1st of March. Okay, 1st of March, 29th of February. So let's go to February. Okay, 20 something of February, 29th of February, 19, 27, 29. Okay, there you go. If the move is going down, that means we will have a stronger Japanese yen and weaker US dollar, right? So unemployment rate came okay. Consumer confidence was higher. Okay, consumer confidence was higher. Retail sales was okay. Industrial production was not good. Here, GDP growth was bad for the US dollar. Okay, there we have it. Thursday, 29th of February. So what we will do, 29th of February here. GDP worst than expected for US. Okay. Next, there we go. 27th of February, 2%, 2.2%. So higher core inflation for Japan. And we all know that this is really good. This was on Tuesday, 27, somewhere here. Higher CPI in Japan. And this pretty much made the move to happen. Done. This is it. Simple as it is. Simple as it is. This is how we backtest. Of course, you would have to go, to replay. Like, let's say here. I don't have the full one, but anyways. This is how you would go through. And simple as it. All right. So this is what we're going to be doing. We're going to pick a pair. We're going to be going through, let's say, euro dollar, that it's a pretty good, pretty standard one. and we're going to go from there. Okay, so you guys have any questions for today? Euro dollar down, NFP good, and so on. All good? No questions. Okay, guys. So I hope everyone have a good weekend ahead. I won't be working tomorrow, as of I will have to pick up my parents from the airport. Coming back from Brazil, they've, they went there to stay for holiday. And yeah, that's all. Hope everyone have a lovely weekend and take care. Enjoy your family. And again, do discipline. Be disciplined. All right. Thanks, everyone. I see you on Monday on YouTube, and Tuesday on the webinar. See you guys. Bye-bye.